Hello, fellow RoboCapitals. Hope you're well. So we've got interest rates exploding higher, not just in the United States, but in Japan as well. It's getting a lot of press. Is this the sell America or maybe sell Japan and America trade all over again because of the tariffs? Let's dive into exactly what's happening, try to put the pieces of the puzzle together. We're going to start by going over to CNBC. And they asked the question. Here we go, right in the title. This is Sell America. Well, they're not even asking the question. They're making a statement. This is Sell America. US dollar, treasury prices tumble, and gold spikes as globe flees to US assets. You know what's amazing is how short the mainstream media and social media's memory actually is. If I go back to April, wasn't there something called, well, I call it retardation day. That's the most appropriate way to describe it. But wasn't there this liberation day thing? And oh yeah, what happened back then? Oh, that's right, it was Sell America. Remember, sell the US dollar, interest rate spike. Oh my gosh. The Fed has lost control of the long end of the curve. Everyone's dumping treasuries. China's dumping treasuries. They hate Trump. Blah, 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 blah. And then what happens 2 weeks later? Oh, the dollar goes back up to where it was. Interest rates go back down lower than they were before. And it's like the conclusion I think you have to come to is there's some sort of mechanical thing that's going on. Not like a carry trade. And by the way, is this blatantly AI? I just noticed that. Come on, CNBC. I mean, whenever you see a dash like this, I don't know what that's called, but obviously that's AI. So if you're going to use AI for your titles, CNBC, at least take out this thing that makes it blatantly obvious that you're using ChatGPT. But anyway, getting back to it here. When we see the long end blow out like it absolutely is today, the 10-year treasury is up like 6 or 7 basis points, something like that. There's some sort of mechanical reason for this. Now, it's big hedge funds or financial institutions get caught off sides somehow. Then Trump comes out, makes a tweet that we're going to take over Greenland or whatever he's saying, and we're going to implement 3,000% tariffs on French wine or whatever, or I don't like Macron. He looked at me the wrong way, and therefore we're going to put a 200% tariff on French champagne or whatever. I don't like Macron's nose, whatever Trump is going to say. And so then the market just freaks out. And then you've got big financial institutions that somehow get caught off sides and they have to unwind a trade. That's my closest guess as to what happened before. And we see the exact same thing happen now. So there are no certainties, only probabilities, but I would assume the exact same, or this will play out the exact same way it did last time. And we're going to go over how it played out last time. So here we go. Key talking points. Sell America, trade in full swing. Okay. President Donald Trump latest threats around Greenland push global investors to shift exposure away from U.S.-centric investments. Well, then why is the JGB doing the exact same thing, but even more? Are global investors somehow taking their frustration out on the JGB market that they have for Donald Trump? Come on. Well, these things, these headlines or these narratives, when they make sense when you just read the headline, like the narrative, right? But once you just scratch beneath the surface, just one level, like the whole narrative completely falls apart. But anyway, let's get back to it. The US dollar index headed for its biggest decline since, April. And while we're at it, let's go to the DXY. It is down big. I mean, there's no getting around that. But let's go back to April to see how this played out before. I keep forgetting year to date is no longer 2025. Okay, so here is this big, huge plummet that we had, and it goes down, plummet, and then kind of goes back up and then churn. Now we get down after retardation day. All that was kind of gone by the wayside, and it goes down to a 96 handle. Then it kind of goes back up to where we were trading 99, pretty much where we were going all the way back to late April. In fact, even higher than we were in late April, but not quite as high as we were before retardation day. That's for sure. But I think you just see, quick knee-jerk reaction, and it just goes right back. In fact, I would say the same thing for the S&P 500. Let's go over there and check out what's happening with the S&P. And as you can kind of gather from the title, we've got the S&P down 2% today, 143 points. I would not be surprised if we're at all-time highs within a week. I mean, I get it. This is kind of catches the market off guard, but how big of a deal can Greenland possibly be? And then you've got the whole taco trade, which it doesn't happen all the time. Meaning Trump backing down. Sure as hell didn't back down with Venezuela. Although lately he has, but not with Maduro. But, what are the chances this Greenland thing blows up? Probably not much. And then the market's just going to use it as, let's just say that it does blow up. Fine. The market's just going to say, oh, wait a minute. We forgot. That means the Fed's going to drop rates. Bye. So it's just when you're in this bullish mode of just euphoria, the market just spins. You have a day or two where it's like, oh, what happened? No, sell. And then it's right back to the passive bid, just the buy, Jim Cramer, CNBC, stocks always go higher, buy the dip, blah, 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 blah. And we've seen it over and over and over again. I don't see why it plays out any different this time. I mean, when it doesn't play out is when the labor market gets so bad, and then that really starts to impact GDP. And then I think you see the bad news become bad news. But until that time, I think good news is good news and bad news is good news. So my prediction, if you want one, is wherever we are, whatever happened today, will be fully erased within a week. I would say not just within the S&P 500, within the NASDAQ, and likely in the bond market, the long end of the curve, because the front end, the 2-year really isn't moving much at all. You can see the 2-year just up basically 1 basis point, where the 10-year up almost 7 basis points on the day. Big steepener. By the way, I need to point out that if you are a Rebel Capitalist Pro member, you have some incredible insights there, because one of the trades that I've put on in my own portfolio that all the Rebel Capitalist Pro members know about is the Steepener trade. I've mentioned it a few times on this channel, so you guys have probably heard me talk about it before, but that's where I go long 2-year futures and I go short the 10-year futures. So I play the delta, right? So if you get a bear steepener because of inflation, growth in inflation expectations, you win. And if you get a recession, then you get the bull steepener likely, because the front end drops faster than the long end, and you win. So that's why I like the steepener trades in this part of the cycle a little bit more than I like just the absolute directional bets on the interest rates themselves, because that you get a lot of noise in there. I mean, you look at 2008, for heaven's sakes. I mention this all the time, but from March of 2008 to July of 2008, the 10-year treasury went up by 100 basis points. So in these cycles, it's never a straight line. It's always this massive roller coaster ride. But what usually isn't a roller coaster ride is the steepener. So anyway, just full disclosure, I've got that trade on. So today was a great day for me because I own silver. I've owned silver. I wish I was in the whole time, but I've only owned it for maybe 2 or 3 weeks. But again, if you're a Rebel Capitalist Pro member, you know that because you get my trade alerts. Anyway, getting back to the nitty gritty, let's go back to CNBC and the sell America trade. It's so ridiculous. I'm not a big fan of, you guys know I'm very bearish on the U.S. economy. That's for sure. The market may be different, but I mean, there's no doubt it's in a bubble, but that doesn't necessarily mean you're bearish. But the U.S. economy, I don't know that there's any way to argue unless you just exclusively look at GDP and completely ignore the labor market. But here's the dollar. I mean, yeah, down today, but I don't know that it's a huge deal. I mean, yesterday I was trading a 99 handle, for heaven's sakes. And that's after retardation day. That's after the last round of quote unquote sell America. So if we're selling America in the US dollar, the DXY, is still trading at a 99 handle. Come on. So the latest flare-up is after Trump imposes 10% tariffs on 8 European countries as part of the push to take over Greenland. Greenland has repeatedly rejected Trump's request to purchase the Arctic island. It is a little baffling. I mean, it's always about resources at the end of the day. It's always about one of two things: either resources or some sort of strategic move against our enemies, China, Russia, etc. So maybe Greenland is both. But is Trump going to do it through these tariffs and what? Maybe, but I mean, I highly doubt it. And so where he made this announcement, by the way, was at our favorite place, the World Economic Forum. Yay! I don't think Klaus is there anymore. He had to retire in just a whirlwind of shame because you have all these accusations. Shocker, right? So I guess this is a quote from Dalio. Let's read that. If you take the conflicts, you can't ignore the possibility of capital wars. In other words, maybe there's not the same inclination to buy U.S. debt and so on. Dalio, come on. Dude, you've been saying this for 5 years, and just show me a time. Now, in fact, that gives me a good opportunity to go over to Japan. So let's go over to the JGBs, which absolutely are spiking today and over the last few days for sure. So we're going to go over to bonds, go over to the 10-year JGB, up 10 basis points just today. I mean, that's a huge move in the JGBs. Look at this, just last 5 days. I mean, you go from 215 up to 237. I mean, you're talking what, 22 basis point move in just within the last 5 days. And that's a big, 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 big move. Now, the narrative that you're going to hear is, oh, this is just the bond market rejecting all the debt and deficits, the debt and deficits, the debt and deficits. And this is what Dalio has been talking about for a long, long time. As if the debt and deficits just got massively worse over the last 3 days. I mean, come on. So the only thing that's really triggered this, the catalyst that you'd look for, is something other than debt and deficits, because debt and deficits have been going actually down in Japan. So I don't really think this is about debt and deficits, right? In fact, just let me show you the receipts here. If we go to, let's see, chart of Japan, we'll do debt to GDP. There you go. So you go back to 2020 and you're at 258%, and it just goes straight down. In fact, you're lower today than you were in 2019. You're actually, see, 232.35. You're actually lower than you were in 2018. In fact, you're lower than you were in 2014. So the debt to GDP in Japan right now is, just write this down. Focus on this, guys. The debt to GDP in Japan right now is lower than it was in 2014. And yet you're going to tell me that this move in the JGBs is a result of debt and deficits? Come on. It's nonsense, right? This is a perfect example of one of those narratives that sounds plausible when, in fact, it sounds totally legit when you just look at this chart. You're like, whoa, yeah, the bond vigilantes are back. They're putting it to, the government. They're not going to get away with these debt and deficits any longer. So why? Why now when they didn't do it from 2014 to 2024, when it's the exact same debt to GDP? You see, again, narrative makes sense if you just look at this chart, but once you scratch beneath the surface, it just completely falls apart. And then to take it a step further, if you look at the nominal GDP, again, growth and inflation expectations, you see that the last GDP print for Japan, 4%. 4%. 4%. And the 10-year JGB is trading at 2.37. Like that's actually, if you want to get down to brass tacks, that's low. It should be trading way higher than that. Not, not due to debt and deficits, but just due to simply nominal GDP. So what this tells you is that the market is expecting nominal GDP probably to go down in the future, not up. Why do you have this whole move here? Probably because the market is like, oh, there's no way we're going to get inflation. No way we're getting inflation. No way we're going to get inflation. And then you get some inflation, and they're like, holy cow, we were wrong. Maybe this is it. This is the day that the interest rates start going up. So everyone sells. Now, is that a result of debt and deficits? No, that's a result of nominal GDP and inflation actually going higher than expected in Japan. Like it's always about, especially in developed markets, it's always about nominal GDP growth and inflation expectations, not debt and deficits. In fact, I would challenge any of you or anyone, on social media or anyone in the mainstream media, I would challenge Dalio, in fact, just to show me a market where the 10-year sovereign bond is trading, let's just say 300 basis points above nominal GDP. Just show me that in a developed economy. I don't think you can. In fact, maybe I should do that for the next whiteboard video. Just do a deep dive on that. But if you can't show me a developed economy where the 10-year sovereign bond is trading at 300 basis points above nominal GDP, and then you look and you try to adjust for or see if there's a correlation between debt to GDP and the actual delta between the 10-year sovereign bond and nominal GDP, and you can't find any correlation whatsoever, if not maybe an inverse correlation, then you have to start coming to the conclusion that this narrative is just complete. It's nonsense. It's nonsense. Although it sounds very, very plausible if you just strictly look at this chart. Okay, now let's get back to gold and silver and see what gold and silver is doing. As you would expect, gold now, is gold up because of debt and deficits? Is gold up because of inflation? No. It's up because of counterparty risk, which is the one thing that I can find that really makes gold move, which is interesting, right? Because again, you go back to the narratives and it's always, oh, it's the inverse of the dollar. Oh, it's an inflation hedge. Oh, it's therefore, if inflation is going higher, then the price of gold is going higher as well. You really can't find anything over long term other than over the long term. You're talking decades. Gold always maintains its value as far as its purchasing power. Always. That is absolutely unequivocally true. But it doesn't necessarily mean that gold trades with the CPI or it trades with the rate of inflation. A lot of times it's the exact opposite. But the one thing that I have found where there is a correlation is geopolitical risk and therefore counterparty risk. When you get increased counterparty risk, very often gold goes up. And I think that's what you're seeing here. And I think that's what silver is doing. It's just riding the coattails of gold. And in these cycles, silver always catches up. And when it does, it goes up in much higher levels in percentage terms. And that's what we see today. Gold up 3.5%, silver up almost 6% just today. What an incredible move in silver. Wow. And congratulations. I know a lot of you own silver, and bravo. I mean, you're up almost 100% in just the last couple months. Wow. That's incredible. In full disclosure, I did not catch this move. I've made a lot of money this year in gold, last year in gold. I made a lot of money in the miners as well. But I really stayed away from silver just because the industrial component of it and what I was seeing in the curve and the labor market. But, the chart looks so good. Even I bought right around, it was when we had this breakout right here. So I bought right around there. And then it dipped back down. I almost sold, but I'm like, it hasn't broken through. I held it. And then so I've ridden it from here up to where it is today. And am I selling? Absolutely not. Why? Well, you remember Rebel Capital's Pro, you know, because the number one rule from Marty Zweig, the trend is your friend. And this trend is pretty damn good. That's for sure. That's for sure. But if you want my predictions, I think that what you're seeing today, if I was trading this, which as of right now, I'm not, but if I was, I'd fade everything on the short term, right? I'd fade everything. So rates going up, I would fade that, and the S&P down, I would fade that as well, just over the next week, probably. Okay, guys. Now on that bombshell, I just got done emailing back and forth with a gentleman that knows a lot about commodities, knows a lot about silver, and knows a lot about something else that is breaking out, and that is the Sprott Physical Uranium Trust. That would be Mr. Rick Rule himself. I just got done emailing back and forth with him and his assistant because he is all set to join us at Rebel Capitalist Live 2026. That's right, ladies and gentlemen, right here. Josh put a link in the description. Josh put a link in the chat, please. You guys can see what the insiders have said. There's Hartman right there. You can see who's coming. Darius Dale. That's going to be a lot of fun. Coming to Rebel Capitalist Live for the first time. Everyone's favorite, Kiyosaki. You got Mike Green coming back there. There's Rick Rule, the gentleman I was just referring to. And we're going to add a lot more speakers before we get done. You guys go ahead and get your tickets ASAP, because as we get closer to the event, obviously the prices go up. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.